Assalamualaikum. Hi everybody. Today I'm going to talk about creating a pro forma balance sheet. Pro forma balance sheet based on the percentage of sales method. My lecture today will be based on your textbook by Ross, Westerfield and Jordan, 12th edition, starting from page 98, running through page 100 and 103. Okay, before we proceed with this lecture, you have to know what is meant by pro forma. Pro forma means prediction or ramalan. Pro forma is ramalan or predicted balance sheet. Before we can create a predicted balance sheet or a balance sheet, I'm sure everybody here knows what a balance sheet looks like. Using a percentage of sales method or percent of sales method, we have to make certain assumptions. Okay, the first assumption is that most balance sheet items will increase as the sales increases at the same percentage. Okay, balance sheet items will increase as the same percentage of increase in sales. Okay, balance sheet items will increase as the same percentage of increase in sales. Okay, not all items will increase with the increase in sales. Only some items. Later on, we will talk about what are the items that increase and what are the items that remain constant if the sales increase. It all depends on whether the items are spontaneous or discretionary. Spontaneous or spontan, in bahasa Melayu spontan lah. Spontaneous means the item in the balance sheet will automatically increase with the same percentage of increase in sales. So this item will increase with the same percentage of increase in sales. What are some of the spontaneous items? On the asset sides, things like cash, account receivables, inventories, and later on we will see some other things. Okay, on the liability side, items like accounts payable will increase with increase in sales. However, notes payable will remain constant. We will discuss this later when we attempt past semesters questions. So only accounts payable will increase with the same percentage of increase in sales. Okay, what about the fixed assets? Okay, for fixed assets, it all depends on the assumptions whether the firm is operating at below capacity, or full capacity. Below capacity or full capacity. If the item, if the firm is operating at below capacity, the fixed assets remain constant. Fixed asset constant. It means that the fixed asset does not increase with an increase in sales. However, if the firm is operating at full capacity, the fixed assets will also increase as the same percentage of increase in sales. The fixed assets will increase with the same percentage of increase in sales. Okay, let us take a look at the example stated in our textbook. Okay, so you can read through starting from page 98 of the textbook. We begin with an example of Rosengarten Corporation. Okay, Rosengarten Corporation, we are given an income statement for at table 4.1, and then we are also given at table 4.3, we are given the balance sheet of the original balance sheet of the company. Okay, we start with the sales in the current year. Okay, so this is the sales figure for the current. This is a averaged ataupun simplified income statement. Of course, the real income statement would be much more complex than this. So this is a simplified income statement. Penyata pendapatan yang direngkaskan, ya, penyata pendapatan yang direngkaskan. So here we have sales of 1,000, and then the cost of 833. So the taxable income is 167. 1,000 minus 800